Hey everybody, welcome back to the channel. So get this. Canada, our neighbor to the north, has decided to pivot, forging new trade alliances that are leaving some iconic American companies scrambling. The headline today is Wild 7 Major U.S. Brands Crash, after Canada chooses new trade partners over America. We're going to dive deep into the 7 companies feeling the heat the most. Let's get into it. Alright, first up, let's talk about Ford. For years, Canada has been one of Ford's most reliable and profitable markets. But overnight, it feels like someone slammed the brakes on that relationship. With Canada's new trade deals favoring European and Asian automakers, Ford's sales have absolutely plummeted. Dealerships in Toronto, Vancouver, and Calgary are now sitting on inventory. The new trade agreements have introduced tariffs on American-made vehicles, making them significantly more expensive. The ripple effect is brutal, with massive layoffs at Ford's Canadian assembly plants. The company is trying to pivot, maybe focus on electric vehicles, but the immediate damage to their market share is staggering. For Ford, the road ahead in Canada looks incredibly bumpy. They need a whole new map. Next on the list is McDonald's. The situation in Canada has turned into a logistical nightmare for them. McDonald's in Canada has always relied heavily on a seamless cross-border supply chain with the U.S. But these new trade agreements have thrown a giant wrench into the works. We're talking about trucks full of potatoes and beef stuck at the border for days. This has led to something you'd never expect to see at a McDonald's: shortages. The cost of doing business has skyrocketed, and the price of a combo meal has gone up. For McDonald's, the golden age in Canada might be losing its shine. Now let's talk about the retail giant Walmart. The seamless flow of goods from American distribution centers to Canadian stores is gone. Walk into a Walmart in Canada right now and you might be shocked. Instead of aisles packed to the ceiling, you're seeing more and more empty shelves. This has opened the door wide open for competition. New international retailers, particularly from Europe and Asia, are flooding into the Canadian market. They're discovering German grocery chains and Japanese home goods stores that are fully stocked. Can Walmart still be Walmart if it can't guarantee low prices on the brands its customers have come to expect? You know the saying, have a Coke and a smile? Coca-Cola is more than a drink, it's a cultural icon. But this new trade landscape is proving to be a bitter pill to swallow. The company's massive, intricate distribution network is now facing major disruptions. The key ingredients and syrups for many of its flagship products are produced in the United States. Coca-Cola is caught between a rock and a hard place. Either they absorb the costs or raise prices. Local Canadian beverage companies are seeing a massive surge in popularity. The fizz is definitely fading for Coca-Cola in the Great White North. Alright, let's switch gears to tech. Apple, the brand that defines cool, innovation, and premium quality, is facing issues. The main issue is tariffs and import restrictions on high-tech electronics from the United States. Shipments are being delayed at customs, and the new tariffs are adding a hefty premium to the final retail price. This price gap is pushing some consumers to look for alternatives. Competing smartphone and laptop makers from countries with favorable trade deals are suddenly looking more attractive. Canadians are using third-party shipping services to get around the high Canadian prices. The seamless, premium experience Apple promises is being tarnished. Just like Ford, General Motors is feeling the pain of this trade shift. The GM plants in Oshawa and Ingersoll, Ontario, are critical cogs in the company's continental production machine. The new agreements have disrupted the supply chain for auto parts. This has led to major production slowdowns at GM's Canadian plants. GM has had to announce temporary shutdowns and significant layoffs at its Canadian facilities. The slowdowns in Canada have a domino effect on their United States plants. GM is now in a desperate race to reconfigure its entire supply chain. In the meantime, they're losing production volume and market share. Finally, let's look at Nike. Nike has long dominated the Canadian athletic apparel and footwear market, but the new trade environment has seriously tripped them up. Their sneakers, apparel, and equipment have all become more expensive in Canada. This price pressure has created a huge opportunity for competitors. European brands like Adidas and Puma are able to offer their products at more competitive prices. Canadian-born brands like Lululemon and Roots are gaining ground. Nike is trying to fight back with Canada-specific marketing campaigns, but it's a tough battle. So there you have it. 7 American giants, Ford, McDonald's, Walmart, Coca-Cola, Apple, GM, and Nike, all facing an unprecedented crisis in Canada. It's a perfect storm of supply chain nightmares, crippling tariffs, and empowered competitors. This isn't just a business story, it's about jobs, communities, and a relationship between two neighbors that's being fundamentally redefined. The speed at which this has unfolded is a stark reminder of just how quickly the global landscape can change. These companies are now in a desperate scramble to adapt. The decisions they make in the coming months will be critical. Thanks for watching.